So there's this new report making the rounds, and whoa, the claim it makes is pretty stunning. Dubai's red hot property market, it might not just be a boom, it might be the single largest real estate bubble in history. The numbers seem almost impossible to believe, but they're coming directly from official sources. All right, let's dive right into this and see what the data is actually telling us.
Okay, get ready for this number. It's a big one. Based on its current path, Dubai is on track to sell a staggering 135,000 off-plan residential units in 2025, just in that single year. We're talking about property that hasn't even been built yet. Now, to really put that into perspective, let's see how it stacks up against some of the other major property hubs in the world.
And the sheer scale here, it's just astounding. Dubai didn't just sell a lot of units. It sold more than New York City, London, Singapore, and Hong Kong combined. Actually, scratch that. It sold more than double, all of them put together. I mean, at this pace, Dubai would literally replace its entire existing housing stock in just 6 or 7 years, which, leads to a pretty obvious question.
Yeah, exactly. I mean, for a city of 4 million people, where is the demand coming from to fill hundreds of thousands of brand new apartments? This, right here, is the central mystery that the report really sets out to solve.
So first up, let's tackle the great demand mystery. And the way the report does this is pretty clever. It tests Dubai's insane numbers against what is probably the world's most successful magnet for professional talent. And they call this the Singapore test. Now you might be asking, why Singapore? Well, it's pretty simple. For decades, it's been the absolute gold standard for attracting top-tier global professionals, right? Low taxes, world-class infrastructure, the whole deal. It's basically the best-case scenario for organic, high-income population growth. And after 30 years, that's 3 decades of non-stop effort, Singapore has managed to build a total professional expat workforce of about 300,000 to 400,000 people. That's a huge achievement. Okay, hold that number in your head for a second. And that, right there, just perfectly illustrates the problem. The number of off-plan units Dubai is on track to sell in one single year is enough to house Singapore's entire professional expat population that took 30 years to build. So yes, something else is clearly going on here. This demand, it's not what it looks like. So this brings us to the real financial guts of the issue, Section 2, Land, Lies, and Depreciation. And it asks a really simple question. When you buy an apartment in Dubai, what are you actually buying? Okay, to really get this, we need to wrap our heads around a key concept. FSI adjusted land value. Sounds complicated, right? But it's actually pretty simple. Think of it this way. Any property has 2 parts. You've got the land it sits on, which holds its value or maybe even goes up. And then you have the physical building, which is, well, it's a depreciating asset. It gets old, it needs repairs, it loses value over time. So the crucial question is, how much of your purchase price is timeless land versus how much is just a wasting asset? All right, so this table breaks it all down for us. Look at a prime spot like Dubai Marina. The land makes up about 60% of the price. That's a pretty solid foundation. But now look at the outer ring areas, places like Dubai South, where the bulk of all these new sales are happening. The land component, it's just 11% of the purchase price. You're not really buying land. You're almost entirely buying the building. And this chart? This shows the terrifying consequence of that. The report projects the value in 15 years based on the land value plus a building that's lost half its value. For Dubai Marina, the loss is, it's manageable. But for a place like Jumeirah Village Circle, it implies a 53% loss. And for Dubai South, a staggering 73% destruction of value. So you might be thinking, well, can't rents save these investments? Nope. The report shows that rents would need to jump over 50% in places like Dubai South just to make the current prices make any sense. And that's at a time when rents are actually slowing down. The conclusion is pretty stark. This market is priced for a high-income buyer that, according to local salary data, just doesn't exist in large enough numbers. So, if it's not for conventional housing, and we know local salaries can't possibly support it, who on earth are the real buyers? What is the true purpose behind these 135,000 transactions a year? And here it is, the report's central thesis.
The majority of these purchases, they aren't even real estate decisions. They are what the author calls the 2 million dirham call option. See, the Golden Visa requires a property purchase of at least 2 million AED. So people aren't buying a home, they're buying the option to move to Dubai in the future, and there just happens to be a property attached to it. They're almost indifferent to its actual value. The report breaks down the buyers into these 4 distinct waves. The first 3 are either old news, way too small, or too high-end to explain this massive volume we're seeing. The real engine, the one driving everything, it's wave 4, the digital gray economy. We're talking crypto traders, drop shippers, online coaches. For them, a 2 million dirham apartment isn't an investment. It's a cheap insurance policy against taxes back home, even if the property itself eventually goes to zero.
And here's the real kicker. Here's how the whole market gets twisted. That 2 million dirham visa requirement becomes a totally artificial price floor. A developer building in some outer ring area isn't pricing a property based on what it costs to build. No, they're pricing it to get the buyer as close to that 2 million dirham magic number as possible. And this just blows up developer margins from a healthy 15 to 25% to an incredible 40 to 60%. Okay, so if the market is being driven by visa seekers and not actual fundamentals, just how big is this bubble we're talking about? Let's zoom out for a second and put Dubai's market into a global historical context.
This slide, honestly, it's just mind-boggling. It compares the total value of a country's housing market to its entire economic output, its GDP. Look at this. At the absolute peak of its infamous bubble, Hong Kong's property market was worth about 8 times its GDP. Japan's was around 4 times. Dubai, at its current trajectory, is projected to hit somewhere between 12 and 21 times its GDP. No economy in the history of the world has ever sustained that. Ever.
But wait, you might be thinking, what about all the cash buyers? Isn't that a good thing, a sign of a strong market? Well, according to this report, it's the exact opposite. It's actually a sign of extreme fragility. These indifferent sellers, the ones who bought for the visa, have already mentally written off the cost. So in a downturn, they're not going to fight to get a good price. They'll just dump the property for whatever they can get, which could accelerate a crash like you wouldn't believe. Now, to be fair, the report isn't saying all of Dubai is a bubble. It's more nuanced than that. To really understand what the future might hold, you have to see it as 2 completely separate markets. So on one side, you've got the prime established core. Think places like Dubai Marina. Here, land value is high, there's actual genuine scarcity, and you have resident owners who live and work there. This market is definitely expensive, but it's real. But then you have the other Dubai, the outer ring off-plan market. Here, land value is minimal, supply is basically unlimited, and it's completely dominated by those visa option buyers. And this, right here, is probably the most critical warning in the entire report. This outer ring market, it won't have a slow, gradual correction. The report argues that when the visa-driven demand finally stops, it will suddenly and violently reprice to its fundamental value, which, as we saw, is based on a tiny, tiny slice of land. And that leaves us with the final, pretty chilling question this whole analysis poses. The question isn't if this outer ring market corrects, it's about the scale of it. Is it going to be a painful 30% drop, back to a level where rental yields might make some kind of sense? Or will it be a catastrophic 50 to 75% repricing, all the way back down to the fundamental value of the dirt it was built on?